welcome to Credit Compass, your guide to navigating European credit markets. This week we start in Germany, where the credit story is caught between stress and repair. Labor market headlines remain relatively stable, but hiring signals are weakening. Corporate insolvencies are still rising, and parts of the Schuldschein market, a traditionally conservative corner of German private debt, are showing signs of strain. At the same time, proposed pension reforms could become a long-term positive for German and European capital markets. We then zoom out to Europeans' industrial policy shift. The new EU steel safeguards point to a more defensive version of globalization, still open to trade but with a firmer hand, willing to protect strategic capacity from global overcapacity and subsidized imports. After that, we will touch on the AI debt trade, where heavy investment in data centers, chips, power, and infrastructure is adding a new wave of long-dated corporate bond supply. Finally, we close with the European Central Bank, where the message is simple. Rate risk has not disappeared, and policy remains firmly data-dependent. All right, let's dig in. Let's start with Germany. The country has struggled to generate a convincing economic turnaround. Manufacturing remains fragile, energy costs are still a pressure point, and the auto sector continues to face a structural reset. Volkswagen is the most visible example. Recent reports suggest the company is considering a much deeper restructuring, including additional job cuts and possible German plant closures. Because not all details have been formally confirmed, this is best treated as a developing story rather than a settled announcement. The labor market headline is not collapsing, but it is not strong either. Germany's unemployment rate stood at 6.2% in June, after 6.3% in May and 6.4% in March and April. That looks stable, but the underlying message is weaker. Hiring demand remains subdued, and the IFO employment barometer fell again in June, suggesting more companies are planning to cut jobs rather than add them. Corporate distress is also still working through the system. German business insolvencies rose nearly 16% year over year in March 2026, with over 2,000 business insolvencies recorded. Insolvencies are often a lagging indicator, which suggests that we should be nearing the end of this cycle, but it has been a long turn so far. Insolvencies indicate that conditions were difficult, but that some companies have already run out of time. Now, this brings us to the Schuldschein market. For listeners less familiar with it, Schuldschein is a form of German private debt, privately placed loans often arranged through banks, typically used by mid-sized and larger companies. Think of it as European private credit before private credit became the fashionable term. Historically, this market has skewed towards stronger, often investment-grade-like borrowers, and that is why distress in this corner of the market deserves some attention. Even if a traditionally conservative funding channel is seeing stress, it tells us the corporate adjustment cycle is not finished. Now, to bring the mood up a little, Germany is not a complete distress story. These are arguably indicating a turning of the cycle in the country. There are signs of stabilization. Manufacturing PMIs have moved back about toward the 50 line, which signals something closer to the potential for future growth than to further contraction. This is not a boom, but it is better than a sharp deterioration. The next data points to watch in the coming weeks are factory orders, industrial production, and energy-related developments, especially as the Strait of Hormuz reopens only gradually and shipping risks still remain unsettled. One major long-term policy development, though, is Germany's pension reform proposal. A government-appointed commission has put forward a package of recommendations that includes a new funded pension component, broader pension coverage, and changes to the retirement age framework. In plain English, Germany is considering building an investment reservoir alongside its traditional pay-as-you-go state pension. Germany's demographic challenge is simple but powerful. Fewer workers are being asked to support more retirees. A pension system under that pressure has only a few levers: higher contributions, later retirement, lower benefits, more fiscal transfers, or more investment income. The reform proposal tries to use a combination of those tools. From a capital markets perspective, this is constructive, but it is a slow burn story. A mandatory funded pension layer could eventually create a recurring pool of long-term savings flowing into equities, investment-grade credit, infrastructure debt, and diversified funds. That could deepen Europe's capital markets and reduce the region's historic reliance on banks as the main savings channel. But this is not an overnight buy Germany story. The market impact depends on governance. If the funded pillar is independent, diversified, low cost, and protected from political interference, it could become a powerful structural buyer of risk assets over the next decade. If it is watered down, however, in Parliament or steered towards political objectives, the impact will be much smaller. Now, turning to something related as the German industrial sector faces its challenges, is Europe really getting tough and caving into deglobalization? This past week, the European Union is cutting the volume of tariff-free steel imports and sharply raising the duty on steel that exceeds those quotas, with a new regime placing the previous safeguard from the 1st of July 2026 to protect EU producers from global overcapacity. In macro terms, it is trying to stop cheap surplus steel, especially redirected supply linked to China, from depressing European prices and capacity utilization, though the trade-off is higher input costs for downstream sectors such as autos, machinery, and construction. Europe is not necessarily caving in to deglobalization with these actions, but the steel protectionism shows it is no longer treating globalization as a costless default. The proposed tightening of steel import quotas is a response to excess global capacity, weak domestic industrial demand, and the risk that subsidized imports transmit deflationary margin pressure into Europe's manufacturing base. Policymakers are trying to preserve strategic capacity and employment, but there is a trade-off. Protection may support margins and investment in upstream industry, yet it can also raise input costs for downstream sectors and keep inflation stickier than it otherwise would be. Europe is arguably not abandoning global trade. It is Europe moving toward a more managed, defensive version of openness, where reliance and industrial capacity now sit alongside efficiency as macro policy objectives. There is likely more to come as Europe turns its focus on more than just steel to other subsidized industries. Now, lastly, equity markets continue to debate whether AI investment is a bubble, a build-out, or some combination of both. On the credit side, markets have remained more resilient, but the AI build-out is changing the supply picture. Large technology companies and related infrastructure borrowers need enormous amounts of capital for data centers, semiconductors, electricity, cooling, and connectivity. That means more long-dated investment-grade debt. The issue is not simply borrower quality. Many of these issuers are strong credits. The issue is duration supply. In other words, who absorbs all these long maturity bonds, and what do investors buy less of to make room? Some strategists worry that AI-related debt could compete with government bonds for investor demand and interest. A more precise way to say that is that AI issuance may crowd investors' duration budgets, even if it does not literally crowd out sovereign markets. Finally, let's turn to the European Central Bank. The rate rise risk is not fully off the table. In June, the ECB raised its key rates by 25 basis points, pointing to inflation pressure from the Middle East energy shock and emphasizing a meeting-by-meeting data-dependent approach. For credit investors, that means the backdrop is improving in some ways, but it is not risk-free. A better growth outlook could support spreads, especially if Germany's fiscal push into infrastructure and defense begins to feed through. But energy remains a key uncertainty. Refinancing costs are still meaningful, and corporate distress has not fully peaked. This is a market that wants to move back into a more constructive framework, but it still needs confirmation from the data. The bottom line, Germany is showing signs of repair, not yet a clean recovery. Pension reform could be a long-term positive for European capital formation. AI debt issuance is becoming a major fixed income theme, and the ECB is reminding markets that rate risk can return quickly when inflation shocks reappear. That's all for this week's edition of Credit Compass. You can find these and other reports on macro and credit trends by visiting kbra.com/macro credit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.